Good afternoon. So hopefully you all managed to catch up with some emails while we sorted that out. I'm Stuart Brown. I'm here to talk to you about Mountain Province diamonds and the diamond industry in general. Obviously, over the last couple of years, it's been quite a difficult market, is probably the politest way to describe it. Diamond prices have been pretty flat and negative. But towards the end of last year, we saw much more improvement, the early signs of some better pricing, and I think for the entire diamond industry, that's what's going to move the dial. I think we're all busy cutting costs, deferring capital where possible, and being as efficient as we can with production. So for me, it's very important that we focus on the revenue and how we do that. And I'd also like to address the lab-grown issues as I go through this very short presentation. So there's a general forward-looking statement disclaimer to make sure that we're all on sides with what I'm about to say and what you hear. I'm more than happy to follow up. If anyone wants to follow up with us, we're around for the next day and a half. The company is a single asset company. We're in joint venture with De Beers, who are the operators of our asset. We own 49% of the asset up in the Northwest Territories. We're some 300 kilometers northeast of Yellowknife in the diamond province of we would call the Ikati, Diavik, and Mine-Gahcho Kué. We're just busy with that big red line coming up to the mines right now, where the winter road is about to open, and our supplies over the next 6 weeks will come in. The main asset consists of 3 kimberlite pipes, the 5034, which is a pipe we started mining last year. We started mining 3 years ago, sorry. And then the Hearn pipe and Tuzo, we started mining Hearn last year, and Tuzo will start mining very late this year. So it's a series of 3 pipes that you'll see laid out. The mine life currently extends to 2028, but we're busy with a new project right now, and we're updating our mine plan and expect to release that late in Q1 2020, so about middle of March. We'll be releasing that. We'll provide more details when we do our conference call early or middle of March. But what that will be releasing is another 6 million tons into the plan and extending the mine life by at least 2 years. 2019, we put out guidance between 42 to 43 million tons. So we're a high ton mover. We've got quite a high strip ratio between 11 and 12 to 1 at the moment as we sort of developing these 3 pipes. So initial high investment in stripping. We spent $1 billion, 1.1 billion Canadian dollars developing the mine with De Beers. We finished all of that. Our sustaining capital on a 100% basis is about $20 million a year. What saves this mine and makes it quite attractive is it's got a very high grade of just under 2 carats per ton. So that makes it quite grade rich. Last year we treated just shy of 3.6 million tons. And that's been our biggest mover in changing the dial on the mine and giving us much more optionality. Over the last year, we've worked very closely with De Beers to try and increase the tonnage throughput because we were capped at about 3.15 million tons due to the configuration, the layout, and the sort of the screen sizes. Together with De Beers, we initiated a few plant initiatives, and they've paid off. So we think our capacity runs at about 3.6 million tons. At a comfortable level, we don't want to stress the plant too much, and our remote location, getting anything in that you didn't get in on the winter road is very cost prohibitive. The total carats produced over the last 2 years, we've done 6.9 and 6.8 million carats. Our average value per carat is sitting at around $65 to $70 a carat over the 2 years, which then comes back to the grade, which helps us enormously. And our cost per ton treated on a Canadian dollar basis is sitting this year at about $100. So we like to think 2019 we had a great year. We exceeded our sort of guidance on the tons moved. We definitely treated more than guidance, and we had a really good 4th quarter after having a bit more of a difficult 3rd quarter. And the carats, we were within our guidance. And we're sitting in 2020, sitting up at the same levels as 2019. So we expect to see the same level of performance, although we do expect to see better diamond price, and I'll touch on that briefly. That's the layout of the mine. We started mining in the middle in the 5034. The annotation called the NEX is called the Northeast Extension. That's the extra 6 million tons I mentioned earlier. So we've been doing continuous drilling as we understand the ore body better. The green blob to the right of the screen is the Wilson kimberlite, which we also discovered last year. It's about 2.5 million tons of additional kimberlite, mostly sitting in our Tuzo strip area. So it becomes very economic for us because we'll be mining that material anyway. And this is the graphic showing the 2028 plan. As I say, we'll be releasing the new mine plan within the next sort of 6 to 8 weeks. We have what we also call the Kennedy North projects, which is the Kelvin kimberlites and the Faraday kimberlites, which lie directly about 9 kilometers northeast of the mine-Gahcho Kué joint venture territory. All the areas in pink there are on our ground, so we own that 100%. We have about $1 billion worth of revenue sitting in the ground, which on a standalone basis was very hard to justify economically, putting through the plant by itself. But given this new capacity that we've generated, the extra 400,000 tons, because we can't make up that tonnage from the mine production due to stripping and equipment constrictions, we think we've now got more flexibility, and we're talking with our JV partner about how do we bring this asset forward and into production. So I think for us, we're quite excited about that. We do have some very good quality diamonds in the kimberlites there, and we think on an incremental basis they will contribute positively. Unfortunately, this takes a lot of work and time, so it's not as simple as just putting it in and adding it to the business plan. We've got to go through a whole lot of steps of environmental approval, which we're very strong on in Canada. The environment there is a very considered process. I don't want to call it slow, it's very thorough, but when you do the work properly, as we've been doing from the life of this mine and from conception on our projects, you get great cooperation from the government in the Northwest Territories. They're as keen for us to bring this mine into production as an additional asset because it extends the life and it helps support Yellowknife. So we have very positive momentum from the government. Turning to the fundamentals of the industry, I promise not to make too much of this, but certainly over the last decade and a bit, we've seen production very high, come off with the global financial crisis, grow enormously in 2015 to 2017, and then the long-promised Argyle closure, which was always the forever savior of the industry, has at last materialized and should happen later this year. And I mention that because it'll take about 10% of the volume of carats off the market. Not necessarily the value, they're very lower, they're much more at the lower end. And people say, well, that's a good thing or a bad thing. It's not a turnover issue. It's the quantum of stones that will become available to be polished. We do see that diamond jewelry markets will continue to grow. We saw relatively positive retail results out of the US and mainland China up to December. Obviously, with the current issues going on in China, it remains to be seen how that's affected the Chinese New Year sales. We don't think that'll be positive, but in the long term, we don't see that this is a major problem in the industry. We do think the world gets richer in terms of the luxury product consumption and fashion jewelry markets, and the diamond jewelry retail markets will certainly grow over time. That would be great if it was just in isolation. And what we get asked, probably the second most popular question is, how's lab-grown affecting you, or synthetics? So if we assume that the $80-odd billion of retail jewelry is going to continue to grow, and we think it should be more aggressively pushed, we do see that there's place for both lab-grown and natural, and we see those as two areas that need to coexist, but they are separate products in our view. And the reason we're very confident about this is if you look at the price differential over the last 4 years, you've seen the margins between the two products grow. As diamonds in the natural space have stayed very stable, they've come down and moved slightly with the way the pricing's moved, but it hasn't moved anything like the diamonds have in the bottom end of the lab-grown area. So the products in lab-grown are getting shorter and shorter in terms of their technology, but their price is coming down, and it's halved over the last 3 years. So in conclusion, although we're a very low dollar per carat producer in terms of what we sell our product for, we do exceptionally well on our cash margin, which is ultimately how I believe you should look at all of the diamond mines. If you're looking at our peers, what we do with our cash after our funding is we're going to reduce our debt and place ourselves in a good position to be part of the increase in diamond prices as we see the future. Thank you very much.